Hello everyone, I'm Miles. Today, let's go back to the basics of accounting and review the three equations that must always hold true on the balance sheet. Assets equal liabilities plus owner's equity. Owner's equity equals paid-in capital plus ending retained earnings. Ending retained earnings equals beginning retained earnings plus net income minus dividends. Why is this important? This isn't just some meaningless mechanical task. Checking these equations proves that every single transaction is consistent, and that every dollar of income or expense flows through assets, liabilities, and equity. They connect the balance sheet with the accrual-based income statement, and the operating cash flow statement is just a cash-based mirror of the same story. These equations tie the three financial statements one system. Let's use same example, accounting 1, ABC Company. On January 1st, the initial transactions are issuing $60,000 in stock, borrowing $70,000, purchasing a truck for $120,000, with a 5-year depreciation period and no residual value, and prepaying $6,000 in rent. Cash equals $60,000 plus $70,000 minus $120,000 minus $6,000, which comes to $4,000. The truck is valued at $120,000. Prepaid rent is $6,000. Total assets are $130,000. Liabilities are $70,000. Paid-in capital is $60,000, and beginning retained earnings are $0. January 2025, operating revenue was $45,000, with $15,000 cash and $30,000 accounts receivable. Expenses are $12,000 wages, $1,000 rent, $2,000 depreciation, $15,000. Pre-tax profit 45 minus 15 equals 30. The tax rate is 20%, so the tax is $6,000. Therefore, net profit is $24,000 with no dividends. As of January 31st, the ending cash balance is $4,000 plus $15,000 plus $50,000, minus $12,000 in advance receipts, minus $6,000 in taxes, totaling $51,000. Accounts receivable is $30,000. Prepaid rent is $5,000. And the net value of the truck is $118,000. Total assets are $204,000. Liabilities are $70,000 in loans plus $50,000 in advance receipts, totaling $120,000. Paid-in capital is $60,000, and ending retained earnings are $24,000. Now let's do the equation check. Equation checks. Assets equal liabilities plus owner's equity. On January 1st, $130,000 equals $70,000 plus $60,000. Correct. On January 31st, $204,000 equals $120,000 plus $84,000. Correct. Owner's equity equals paid-in capital plus ending retained earnings. On January 1st, $60,000 equals $60,000 plus 0. Correct. On January 31st, $84,000 equals $60,000 plus $24,000. Correct. Ending retained earnings equal beginning retained earnings plus net income minus dividends. On January 1st, 0 equals 0 plus 0. Correct. On January 31st, $24,000 equals 0 plus $24,000 minus 0. Correct. These three balance sheet equations bridge profits from the income statement to retained earnings, align the balance sheet, and reflect cash flow liquidity. They prelude the accounting cycle. Master this, and you'll see finance as an integrated language, not three separate reports.